Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Haohai Biological Technology Co. Limited Annual Report. Shanghai Haohai Biological Technology Co. Limited offers a diverse range of products and services across various industries. The company's primary focus lies in the development, manufacture, and sale of biomedical materials globally. In the field of ophthalmology, Haohai provides intraocular lenses, medical sodium hyaluronate gel, lubricant eye drops, and other related products. Additionally, they offer a range of products for burn wounds, anti-adhesion, and medical chidasan. Their product line also includes injectors, scalpels, suture needles, and other surgical equipment. Beyond ophthalmology, Haohai has expanded into the realm of medical aesthetics with their Matrafil, Janlane, and Hyalumatrix dermal fillers. These products cater to various needs, from dynamic filling functions to precise embellishment. The company also offers genetic engineering preparations for epidermal repair and radio frequency devices and laser equipment. Furthermore, Haohai engages in research and development, consultation, and services related to biological engineering and pharmaceutical products. They are involved in technology transfer activities, manufacture and sale of biological reagents, biologicals, and materials, as well as intraocular lenses and related products. The company also sells machines for medical aesthetics, professional life cosmetology, and home cosmetology. In summary, Shanghai Haohai Biological Technology Co., Limited, is a multifaceted company offering a wide array of biomedical materials, ophthalmology products, medical aesthetics solutions, and services across various industries. Shanghai Haohai Biological Technology Co., Limited, market capitalization of $9 billion, is materially smaller than most of its industry peers of roughly $31 billion. Shanghai Haohai Biological Technology Co., Limited, trades at a lower price-to-earnings ratio of 12 times and a lower price-to-book ratio of 0.86 times relative within the industry. This suggests a potential market detachment, as Shanghai Haohai Biological Technology Co., Limited, trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 4.79%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline can be identified through a review of various product categories and market trends. Revenue growth is primarily driven by the success of certain products such as medical aesthetics and wound care products, which saw a significant increase of 15% and 58%, respectively. The strengthened academic promotion of Healin product and increased awareness of its efficacy also contributed to revenue growth. Additionally, the launch of new IOL products with high oxygen permeability and clinical trials for ultra-high oxygen permeable orthokeratology lens products have driven sales volume increases. In terms of specific market trends, the growing number of myopia patients in China and the high prevalence of cataracts in the country have led to increased demand for IOL products. The registration and launch of major pipeline products have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by a decrease in ophthalmology product sales, particularly in the Chinese mainland, Europe, and USA markets. The decline in cataract product line has been significant, contributing to a 24.91% decrease in revenue. Additionally, the medical aesthetics and wound care product lines have seen a decline of 12.99%. Overall, the success of certain products and market trends have driven revenue growth, while declines in specific product categories and markets have led to revenue decline. The net income of the company experienced a significant decline of 40.3% to Rm 51.01 million in the recent period. This decrease is also reflected when compared to the previous year, with a drop of approximately Rm 33.36 million, representing an 8.71% decline. A closer look at the profit margins reveals an even more substantial decline of 57.67% to Rm 60.48 million. Furthermore, the company's profit before tax saw a staggering 65.61% decrease, contributing to this sharp drop in profit margins. The reasons behind these changes are multifaceted and complex. The ophthalmology consumer market has been experiencing weakness since 2023 due to non-essential demand. Additionally, increasing competition from new product approvals and lower-priced alternatives has put pressure on the company's sales. National centralized procurement policies have also intensified industry competition, while a weakening domestic consumer market has further exacerbated the situation. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash flow from operating activities has reached an impressive Rm 490.97 million. This substantial increase is a clear indication that the company is successfully converting its profits into cash, thereby reducing its reliance on external financing sources. This positive trend in operating cash flow is a significant milestone for the company, as it demonstrates its ability to manage its working capital efficiently and effectively. The generation of positive operating cash flow also enables the company to invest in growth initiatives, pay off debts, and reward shareholders, ultimately contributing to its long-term sustainability and success. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there appears to be conflicting information regarding the change from 2024 to 2025. According to page 4, the debt level increased by 9.3%, while pages 21 and 22 indicate a decrease of 11.2% and 11.1%, respectively. Despite this discrepancy, it is clear that there has been some reduction in total debt. The interest expenses have also seen a significant decline, decreasing by approximately Rm 58.98 million compared to the previous year, representing a drop of around 65.61%. This substantial decrease suggests that the company's financial situation may be improving, at least with regards to its interest expenses. Management's outlook for the company is cautiously optimistic. The implementation of IFRS standards amendments is expected to have a minimal effect on financial statements, indicating stability in this area. However, revenue from contracts with customers has decreased by 3% year-over-year, which may be a cause for concern. Despite this decline, management remains confident in the company's performance. They monitor its operating segment closely, using data to inform resource allocation and assessment decisions. Additionally, exchange rate fluctuations are not expected to have a significant impact on the company's future prospects. Overall, management is focused on navigating these challenges while maintaining stability and growth. The company's financial activities have been multifaceted. On one hand, the company has demonstrated a commitment to returning value to its shareholders through dividend payments. This move is indicative of the company's confidence in its financial stability and ability to generate consistent profits. On the other hand, the company has also engaged in share buybacks, which suggests that management believes the stock price does not accurately reflect the company's intrinsic value. By repurchasing shares, the company can reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting the stock price. That concludes the financial summary for Shanghai Haohai Biological Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.